Ever wondered how to use moving averages in trading? It's a common question with surprisingly powerful answers. Moving averages are like the pulse of the market, revealing its rhythm, its patterns. They are key tools used by traders to smooth out price data and generate trend-following indicators. The two main types, simple moving average and exponential moving average, each have their strengths. They help traders make sense of the market's ebb and flow. So, are you ready to discover 5 effective trading strategies using moving averages? Buckle up. The first strategy we're exploring today is the crossover strategy. This strategy is a classic in the world of trading, and for good reason. It involves 2 moving averages, one shorter and one longer. The shorter moving average responds quicker to price changes, while the longer one is more stable and less reactive to market noise. Here's how it works. When the shorter moving average crosses above the longer one, it's a signal to buy. This indicates that the trend might be shifting upwards. On the other hand, when the shorter moving average crosses below the longer one, it's a signal to sell. This suggests that the trend might be moving downwards. The beauty of the crossover strategy is its simplicity. However, it's crucial to remember that timing is everything. If you act too early or too late, you might miss the optimal entry or exit point. Remember, timing is key in the crossover strategy. Next up is the double crossover strategy, a slightly more complex but highly effective approach. This strategy employs not 1, not 2, but 3 moving averages, one short, one medium, and one long. So how does it work? Well, the magic happens when the shortest moving average crosses over the mid-length moving average. This is where traders perk up. When the short moving average crosses above the mid-length one, it's generally seen as a buy signal. On the flip side, when it crosses below, it's taken as a sell signal. But remember, the longest moving average is still in play. It serves as a sort of trend indicator. If the short and mid-length averages cross above the longest one, it signifies a bullish trend. But if they cross below, brace for a bearish trend. This strategy requires a keen eye and quick reflexes, but it can be highly rewarding. Patience and quick action, both are crucial in the double crossover strategy. Now, let's dive into the world of moving average envelopes. This strategy adds a twist to the simple moving average concept, enveloping it with 2 additional lines. Think of these lines as the safety nets above and below a trapeze artist, catching price fluctuations as they swing back and forth. These envelope lines are typically set a certain percentage above and below the moving average. The percentages can vary, but a common choice is 1%. When the price touches the upper envelope, it may be an indication that the stock is overbought and could soon revert to the mean. On the flip side, when the price touches the lower envelope, it could suggest that the stock is oversold and might soon bounce back. It's like a visual representation of market highs and lows, providing traders with potential buy or sell signals. But remember, no strategy is foolproof. In moving average envelopes, it's all about watching those lines. The fourth strategy on our list today is the price action strategy. This unique approach demands a keen eye, as it involves tracking the price's reaction to a moving average. Now, what does that mean? Well, in a nutshell, traders watch closely for instances where the price appears to bounce off the moving average line. When this happens, it can generate potent buy or sell signals. This strategy, like all trading strategies, requires careful observation and patience. It's important to remember that while the price action strategy can be effective, it's not foolproof. The market's volatility can sometimes lead to false signals. But when used wisely, it can certainly be a valuable tool in your trading arsenal. With the price action strategy, your eyes should always be on the price. Last but not least, we have the moving average convergence divergence strategy, or MACD for short. The MACD strategy involves 2 components, 2 moving averages and a histogram. The moving averages represent the fast line and the slow line. When the fast line crosses above the slow line, it's a bullish signal. On the contrary, when the fast line crosses below the slow line, it's a bearish signal. The histogram shows the difference between the fast and slow lines. Traders look for crossovers and divergences in these lines to identify potential trading opportunities. They also pay attention to the histogram, as it can provide additional insights. MACD is a potent tool, but remember, with great power comes great responsibility.